Hello and welcome to today's KraneShares webinar. Our Q3 update, tech leads bull market, trade deal updates, and new goals set in the 15th five-year plan. My name is Brendan Ahern. Today I'm joined, as always, with my London-based colleague, our head of international, Xiaolin Shen. Xiaolin and I are very excited to provide an update on what's been happening in terms of China's economy, capital markets, and arguably most importantly, US-China relations. I think one of the most important things we'll discuss today is the underinvestment in Chinese equities, despite some very strong returns, not only on a year-to-date basis, but certainly going back to the January 2024 low in Chinese equities. Despite these fantastic returns, investors are very much underweight. So we're actually going to articulate, we're actually going to quantify what that underweight looks like. I think without bearing the headline, the most contrarian thing an investors can do is to be long Chinese equities. So on that cliffhanger, first and foremost, if you would like CE credits for CFP, SEMA, as well as the CPD, please email us at ce@kraneshares.com. That's Charlie Edward at kraneshares.com. Xiaolin and I certainly want to provoke a healthy debate, and we hope that provides a lot of Q&A opportunity. If you're joining us on Zoom, please use the Q&A button. If you're streaming us from kraneshares.com, please email us at info@kraneshares.com. Additionally, if you would like the presentation, again, please email us at info@kraneshares. All right, let's dive in very quickly. For those of you less familiar with KraneShares, our founder, Jonathan Crane, moved to China in 2001. In China, he built a successful business, but most importantly, living in Shanghai, he experienced the adoption of mobile technologies, the adoption of new economic drivers within China's economy, driven by China's vast urbanization. Also, moving to China in 2001 was also the first year a foreign investor was allowed to invest in the onshore, the A-share market, the Shanghai and Shenzhen stock exchanges. Over Jonathan's time living in China, that opportunity of access into the mainland markets, that door continued to open. Ultimately, Jonathan sold that business in China to US multinational. Towards the end of the decade, came back here to New York, where he was shocked to see the growth in exchange traded funds. But when he looked at what was and is no longer the largest China ETF, it was all old China. There's no access to these new economic drivers, nor was there any access to onshore China, the Chinese A-share markets. And that was the fruition for creating KraneShares, a China-focused ETF provider. On the next slide, certainly there's a lot more to KraneShares than just China today. We do have a suite of China growth opportunity ETFs, but we've taken things that we've seen in China and applied it to global markets. So we're really well known for, say, KWEB or China ETF. But if you look at KEMQ, it's the EM version of KWEB. Just point out a very strong performer. But we've seen things in China, such as the Tesla's success in China that led to us listing cars here in the US as well as in Europe. Certainly, Xiaolin and team have built out a successful franchise in Europe and UCITS ETFs. And certainly our colleague Luke Oliver is really the global expert in carbon credit allowance futures. But let's dive into the heart of today's, which is China. And one of the first things that we always want to talk about is, constantly we're bombarded with this idea that great investment opportunities are not available in China. You'll see Chinese bears talk about, well, the Shanghai Stock Exchange is at the same level as 10 years ago. And this is absolutely nonsense. the real issue in investing in China, what Jonathan experienced living in China, was you had to find these growth opportunities. And yes, since the S&P, since the global financial crisis low in March of 2009, the S&P 500 is up almost 1,300%, 1,284%. And yes, broad emerging markets is only up 360%. Now the issue specific to emerging markets in China is the definition of China for investors, just as the definition of emerging markets. It was all value stocks. It was half of MSCI China, half of MSCI emerging markets was financials and energy stocks. And when you include industrials, materials, real estate, it was a value proxy. So to articulate the thesis on creating KraneShares would be, well, what did a growth sector in emerging markets do, like technology? That was the thesis behind KEMQ, right? So he actually did better, but that emerging markets was only 10% of the index, which is why if you bought cheap, broad EM beta, you got a return of 360%. Now, it's even more so in the case of China. So we looked at MSCI China Tech. This is the thesis behind KWEB. It went up 3,405% versus the S&P's 1,284%. So you did more than double, but tech was only 2% of MSCI China. It's literally why we created KWEB. Okay, let's, Xiaolin, I know a lot happening in China very recently. Really, most importantly, we have the drawdown. I'll hand things off on some of the advancements we've made in terms of U.S.-China political relations.
Yeah, thank you, Brandon, and good afternoon to all of you who join us today, or good morning if you join from U.S., some of the states in U.S. I think Brandon and I were thinking what we should, absolutely as a key to covering this quarter. And one thing is most important is in investors' minds is always the U.S. and China relationship. So this one, we put them up front, and just to summarize some of the recent developments, I think many of you already know this and seen this on headline is in October 30th, finally Trump and Xi Jinping met in South Korea. They shake hands, and a lot of newspaper had a lot of quite a serious picture. And then I literally circulate internally. We have seen some pictures actually take behind the scene. They both are literally making a very good social, interactions between each other. Apparently, Trump was telling jokes to Xi Jinping. They have a very relaxed atmosphere. This is telling us the 5 months of working in group on both sides by both delegates to meeting each other either in Europe, in London, in Malaysia before the South Korea trip, and all the efforts they've been putting in the last 5 months has finally we were going to see some lights at the end of the tunnel. Maybe the exact timeline is to be decided, but again, at this juncture, you can be very confident to believe from both sides of announcements. One, the framework between U.S. and China's trade talk are being set very firmly and agreed on both sides. And in many ways, how they're going to work under this framework on both sides to make sure, in other ways, both sides' Christmas wish lists get granted. That's a very good positive developments between both U.S. and China. We obviously seen subsequently after they met in South Korea, they both sides reduced significantly on the tariffs they put on each other. That's a step one. Now they're talking on the key needed exports and imports on both sides. China resumed buying the soybean. I think if you look or you follow Brandon CNN every day, you will see that is the first in many months they have resumed, and also China approved the action of importing agriculture product from US thereafter. So all the things are towards to a positive side. I'm not saying everything is going to be just a very smooth road ahead. That's not fair to say. You will probably have some bumpy road ahead, but the bigger picture, the framework, the goal, the aims and objectives are being very clearly laid out. we do expect both sides would announce a very constructive deal from here going forward on both sides. So if you go to the next page, I want to also highlight another key political events happened in China. This is actually a 5-year plan. For those of you who doesn't know what 5-year plan is, it's like you and I have a New Year resolution. This is China as a government has their 5-year, every 5 year they make a plan. This is their 5 years resolution. So this is from 2026, which is next year, until 2030. This is the 15th 5-year plan that is released. Obviously, they hosted in October. These are the key messages here. Obviously, none of this should come as a surprise, as they are very, very much targeting on continuing of their effort of the last 5-year plan. Okay, one namely is modernizing their society. Now they are moving to a stage higher and upper to say, you know what, we're going to build a very modernized industrial systems, i.e. they're going to make very automated advanced manufacturing supply chain in China, period, at the end. So the efforts is very clear, the support from top down, the goal for the country to achieve more advanced manufacturing, more advanced modernized industrial systems are very clear there. Obviously, technology, AI, technology innovation, self-resilience, all these things comes up almost at every single meeting, every single statement from China. I mean, from all the development happened this year thus far, this shouldn't come as a surprise at all. China is focusing on to become more self-sufficient. One, also continue to build and develop and lead in technology innovation in any ways they can. Expanding or reforming and opening up, all these things, I mean, at the end of the day, it's very clear. Obviously, we have a lot of frameworks listed here. You can read it yourself. But one thing I just want to make you remember is really they are helping the people. One thing that the Chinese government has faced the most challenges is how to lead this 1.4 billion nation as a leader in the country. One thing they have to focus, and they always focus, is how to make the society more wealthier, more richer, and continue to advance in many ways that they can. So obviously the consumer consumption should be another big focus. In their 5-year plan, we will have a lot more detailed policies and allocated money to be announced in March when there's NPC. Okay, so now it's really, here you go, this is the framework, go and work on it, on the policy, on planning money we needed, so on and so forth, to achieve this. And March, when we meet each other on NPC, we should talk about exactly what are the policies to help corporates, households, everyone, and the money needed to support this plan. So this is basically the structure. To us is one, they're going to help the people, the consumer consumption still at the front and center is what they need to focus on. Second, technology. No doubt about that. So these are just some of the key takeaways on the last 5-year plan happened literally just a few weeks ago. So if you go to the next page, this is where another campaign introduced domestically in China is called anti-involution. It's really that at some stages where, this is really helping to make sure that the companies in China and continue on developing, innovating, and moving forward with their developments in all the area, in clean energy, renewable energy, in solar panel, in all these, even in electrical vehicles, so on and so forth, to make sure they continue to focus on the developing and getting market share, but at the same time, to not introducing unhealthy competition. Also, this is another way to help them to deal with the deflation measure. Brandon, I don't know if you have anything to add on this page. I was going to mention the October inflation number actually came in with a positive print.
Yeah. I mean, listen, it's 1 month, but I couldn't agree more, Jalen. It's something that was completely unexpected. Obviously all the economists who submit were completely wrong. And it's something that, we've been speaking about that. Could this anti-involution, could that actually shake China out of this deflationary spiral that we've experienced? And I think we're seeing this. Where we've seen the most proverbial action on anti is in the solar industry, and it's interesting that from the Q3 earnings. So remember, this got announced back in the beginning of July, and we've seen polysilicon futures on the Guangzhou exchange increase in price. that really Q3 earnings was the first time, and so the global leaders in solar panel manufacturing, Tongwei and Longi, very, very strong revenue growth, but historically they've lost money because of this excess competition,
Yeah.
and the companies dramatically reduced the amount of that net income loss in Q3. So that's something that we really think can help make these companies more profitable. So yeah, it's early days, but proverbial green shoots on the anti-involution campaign.
I would agree. It's continue to be the policies that introduce top down, and so we will see to more data and more ways to capitalize this policy in the corporate earnings. And obviously, what we also want to discuss on the next page, I guess, everything like Brandon, you went to Asia a lot this year. I bet every conference we go, every conference we attend, AI is absolutely at the front and center for any single conference. I think this year it's very clearly, I mean, it feels a long time ago. The DeepSeek thing was really this year, but it felt like years ago. But it was really at the beginning of this year when DeepSeek break, like everyone realizing that China literally have capabilities to operate really the LLM under lower specs of GPUs, and then particularly for their focus on AI to commercialize their AI capabilities. And we come up with this page to show you a few comparisons between where Chinese firms are focusing on AI in China versus their counterparts in US. Obviously, these are just asked to do a comparison to show you side by side how everything works. Obviously, in China, they not only prefer on open source, they actually focus on the whole ecosystems, right? Just like when we had this e-commerce concept introduced, this probably about 20 years ago, and then they started with, what, we want this to be one stop for all, like everything, like you use WeChat, you can literally do everything in China. You order a taxi, you book a hotel, book restaurants, pay your electricity bill, buy a stock, literally like everything. That's what we meant of the whole ecosystems approach. So China continue the effort in their AI developments and robotics developments to say, what, we still focus in the model that able and capable to covering the whole ecosystem. So obviously, some of the leaders today in US, in China, in US are most private in most of the AI and particularly in robotics spaces. Some are private. Obviously, there are companies are doing do line of a business that have robotics approach to their business as well. But in China, the most public, the leaders that are dominating the AI developments and dominating the developing and commercializing the AI as quickly as possible to bring that to market are the names actually traded in KVAP. So there's also one thing we want all the people who dial in today. I know, we all know that you have been following KraneShares, following KVAP for years. To KVAP is not a new name to you. The name is a very cool name 13 years ago. It's slightly dated, I'd say. Today, the names in the KVAP fund are literally the key leaders and players, not only in e-commerce consumption, they're, platforms like such, they also dominating in such as AI and technology developing, like Alibaba, they're producing their own AI chips today to not only self-supply, and they're also going to supply to others. So this is where we say when you play KWAB, it's actually you playing the huge population in China, also you're benefiting from the leaders. These are literally the guys are leaders in AI and technology developments. And also the robotics is absolutely the, is the key focus now in the market from all the AI to say what's the next stage of using AI to make them applicable, to make them commercialized and used in the real industry, have a real demand, have a real line of revenue to be generated. Obviously, Morgan Stanley are expecting or is expecting 1 billion robots to be on the road by 2050. Was it 2050?
Yeah.
In 20 years' time, we're gonna have a billion robots on the road, so we may as well understand it and see how we can get along, how we can invest, how we can benefit from it. Obviously, today in the robotic supply chain, China obviously is more focusing on the physical hardware, and I would say for more of like applants, usage, and use them, export it to the real in the real life usage in the robots. Obviously, US is more on the software. Nothing one or the other. Both should work together to get that robotics up running. But one thing most important is earnings. Okay, you obviously say I don't mind buying high earnings if the the company give me the good growth, but then you would have companies like KWebs, all the companies in KWebs company trading at PE of 18s and still generating you year over year very high growth. We'll show you some growth later, but this is where you could really have both. One is the evolving trends. One is the trends that market expect to generate trillions of dollars in revenue in the coming years, and at the same time is still hugely undervalued. So this is just a quick recap here. If I go to the next page, I just want to go to a little bit on Alibaba. We used to show some of the audience here, you may remember a few years back, on what are the different lines of revenues or different lines of business that Alibaba is having. This is where, in evidence of what I said early on, yes, we call our fund internet fund, but they are literally the dominant leaders today in the technology space and continue to be the case. Ali obviously is mostly known for their domestic e-commerce platform like Tmall, all these groups to trade, but they also known for the very established logistic. For instance, Lazard. I literally had this opportunity to visit Lazard in Vietnam last year. And Tiny obviously is another logistics company, and same for some of the online video platforms and also the delivery platform, and additionally the financial technology platform like Ant Group. And obviously Ali is heavily in clouds and AI. And this is illustrated if you go to the next page, which show you how all these different lines of revenues and business that is in Ali, in Baidu. You can look at all the different companies in Tencent as here as well. Then you can see the little darker purple color is the revenue that is generated from the cloud business. Brandon, this page and the next page is your favorite page. Do you want to just jump in here?
Yeah, I think it's interesting. When we went and looked at the calendar year Q2 earnings back in August, and in the case of Alibaba, cloud was only 13.5% of their revenue, but obviously that was zero just a few years ago, and it's grew at 26%. In the case of Baidu, their cloud grew. It's up to it's 20% of their revenues cloud today, and it grew 27%. In the case of Tencent, it was 10% of revenue, but grew 15%. And so I think these are very these three companies are really we think just the real way to play AI in China. That to your point, Jal, and DeepSeek is open source, and it's a very different business model in China versus here in the US. And yeah, we ultimately we really believe that the cloud players, these three companies, are going to be the true beneficiaries of of just a very different business model than here in the US. And certainly the Stanford University has an AI index, and the US is certainly still broadly ahead of China, but if you want to look at it at that lens, which I don't necessarily agree in, but certainly in several categories, Chinese, if it's Baidu's ErnieBot or Alibaba Q1, a lot of the Chinese large language models are actually exceeding some of the US equivalents in certain categories. So yeah, it's a different business model, different revenue model, but in KWeb, we're really, really constructive. The one thing I'd point out, Jalen, that in terms of China tech, one area where the valuations are not inexpensive is in some of the semiconductors companies, and you have some very, very high valuations on some of the Chinese semi plays, and I think that's one area where we would maybe warrants a little caution. Even over the last week, we've seen some of these mainland semiconductors underperform, where yes, they've been able to grow revenue, but their net income, some of the EPS has been a little light, and that's where I think one of the great value adds collectively is, to help investors navigate this. And, the different versions of China tech, not I think some of that China tech, you got to be a little careful because of some of these really, really exceeding high valuations on the semiconductor side in China. Something just a little caution out there.
Totally agree. I think this is all a great point taken. I think the other things we always debate ourselves is, if you go to the next page, is Brand is on energy. This is actually, at the very beginning we debated like why all the data centers are in China, because of the cheap cost of energy. And then now it's also because the next layer, which they are very capable of renewable energies. To produce more energies for these data centers to continue to operate in the way they are operating. Obviously, on this page, we show a bit of the cost of electricity and also renewable energies cost by regions and by different countries, to show you and illustrate to you that's where China is sit as today versus 2000, like 20 years ago, that China would be like nowhere near. You see the little blue bar on the very right-hand side. You can see their gigawatts was like, what are they doing? But you see over the 20 years, see their commitments in the renewable energies spaces and how that has fast forward them to become very much a center and data center for all these data centers prefer to be hosted on. Would you
Yeah.
say, Brendan?
Yeah, it's kind of, I think it was just yesterday, Elon Musk said that the key to AI would be solar energy. And that's probably a little self-serving since he owns a solar company. I think we would argue that renewable energy might be a key contributor in AI, and in that sense, again, we don't want to look at this as a U.S. versus China race. We don't look at through that lens, but if that is the lens, then the race is over and China's won, because 50% of China electricity comes from renewables, and renewables, it's not just solar. We'd look at wind, we'd look at hydro, as well as nuclear. And yes, there's so much talk about nuclear in the US. And yes, the US actually produces more nuclear energy than China. It's more of the build out in China of nuclear is really dramatic, versus here it's just talk. It's just talk. And again, I do think that China, the implementation of AI, you'd have to say, China is maybe got some advantages. Again, we don't recommend anyone look through that lens, but yeah, I just don't think that clean tech is really viewed as an AI opportunity. Here in the US, everyone talks uranium and nuclear, but China clean tech, I really believe that's a undiscovered AI play, and something that it's self-serving, because we have our China clean tech ETF, but I do think it's potentially a big beneficiary of what we're seeing in this space.
I'd agree. And then obviously with this, I'll pass to Brendan to finish the rest of the deck. But I just want to, the audience know this quarter, at least up so far, the geopolitical development is towards to more of a constructive, stance. And also domestically, the policies that China been put together is very clear, helping the consumer continue to develop on
Yeah.
technology. And in our belief, the best way you can play, obviously, is to understand what are the trends coming to our life, what are the most immediate commercialized opportunity possible. On the next page, I want to show you, we launched this strategy very recently, few months in US already, but in UCITS land, this is just a less than a month old fund, KOID. We already had a massive client interest on this strategy. This is the Global Humanoid and Embodied Intelligence fund that we have launched under our platform. Again, this is obviously playing the theme that Brendan and I has been discussing, the AI, the next chapter of how you use the AI. The 1 billion robots is coming to the market, and who is going to be the best, player along this entire supply chain on these robots to make the robots possible today. Obviously, our funds started with a huge universe, and then we obviously look at all the technicals of liquidities, market cap, so on and so forth, to come down to nearly 50 name, 50, and equal weight them purely because every single player today on the entire supply chain of these robots is important to each part of it. There may be more emphasis on the whole assembly of the body, given the cost of the body is 55% of the robots. And obviously the other 23% is the brain. So we have more of like, who's the company produce the best muscle for the robots? Who is the best company to produce the skin, the rare earths for the robots? So this fund is a very interesting, it take a global lens into this COID. Obviously has bottom-up selection shows we have 40% in China, we have 25% in US, and then Germany, Japan, and the rest of the countries in the world is the rest of remaining the allocations. Here we show you the ticker is called KOID. It's the same ticker for US and same ticker for UCITS. Brent, anything to add to COID people?
Yeah, I couldn't agree more. And again, I think this is another area where we really I think in our travels to China, but certainly broader Asia, we've experienced firsthand. We've actually seen where Asia's maybe a step or two ahead of Europe and the US, where you actually see some of this is coming to life. And I definitely agree, Jalen. I really think AI, I mean, I don't think the AI story has become a robotic story, but I think Tesla shareholders, last week they voted for Tesla to become a humanoid robotics company. And I think we're seeing, just yesterday, the Chinese EV maker XPeng, unveiled their humanoid robot called Iron. That's going to go into mass production next year. But Unitree, which will be, I think, if Alibaba put KWeb on the map when they went public, I think when Unitree goes public later on this year, it's going to put COID on the map globally. And Unitree's manufacturing 200 humanoid robots a day. So this isn't talk. It's actually happening, and certainly companies like Ubatech and others are actually in that manufacturing stage. And I know we had our colleague Derek went to China, met with some of the different robotics players, and we just want to take a moment and show some of the video that our team was able to film. So we're gonna just transition for a moment and show a little video. We need a little music. All right, here we go.
Yeah, there you go.
Hello, and welcome to today's KraneShares webinar, the $5 trillion humanoid robot opportunity, capitalizing on the boom with COID.
The whole world's developed for humans, and we're not going to go and start redoing infrastructure. And I think it's just the whole reason why humanoids are the next evolution of robotics.
COID is actually the first US-listed ETF to capture the humanoid and embodied intelligence opportunity. This is probably the most exciting opportunity, with Morgan Stanley projecting 1 billion unit of humanoid and up to 5 trillion total addressable market by 2050. That's a big market with rising demand for humanoid manufacturing across the world. With that, we developed COID with our index provider Mercury to have a full spectrum of the ecosystem in the index to really capture all kinds of opportunities, from the brain, the intelligence, to the body, all the components, and also the integrators who assembling and commercialize on humanoid.
We're on the precipice of the adoption of humanoid robotics, driven by the convergence of industrialized manufacturing with artificial intelligence. We really believe that the convergence of these two trends provides a tremendous opportunity for investors.
One thing
Yeah,
we
yeah,
could,
it's
one thing we could do better is we brought Kuwait to Europe to literally did well, in addition to Kuwait bell-ringed Nasdaq, we literally let Kuwait first bell-ringed London Stock Exchange, and then Kuwait literally rocked the whole London. We brought Kuwait to a lot of the symbolic places in London. I just want to, say that obviously we'll continue to help clients to access investment opportunities. That's interesting. We're very excited about this strategy.
Yeah,
Brandon?
and I think, it's we're taking a very diversified approach, and I think about the AI story has not become a robotic story. The rare earth story has not become a robotic story, but these are really, really important drivers, and it is an ecosystem effect. And yeah, I think we've created, self-serving, highly biased. We've created a very thoughtful way to get exposure, to keep things moving. I do think, Jelen, there's a few things that we're starting to see, and one of that is, we still believe that, the number one issue in China is the decline in real estate prices. It's had an effect on urban household wealth, where 2/3 of urban household wealth was invested in real estate. It's had a weighed on consumer confidence and domestic consumption. It's had a downstream effect. It's really, why we believe the Chinese government, should do a trade deal with President Trump, is to address the number one issue in China, which is the real estate crisis. It's not the trade war. And I think it's creating a shift. I think, part of this anti-involution is we've seen a bit of an uptake in investors in China. In I'm told that the mainland China ETF market is actually now larger than Japan's ETF market. That we part of our China re-rating thesis would be that it would start with China, and investors in China are buying Chinese stocks, as we've seen with this tremendous growth of the ETF industry in mainland China. On the other hand, we've also seen investors in China buying Hong Kong stocks, and we're able to monitor that through the Southbound Stock Connect. So on the next slide, we've actually seen 168 billion. This slide is only we did this slide just a few days ago, and it's already out of date. It's up to 168 billion year to date has come out of China into Hong Kong. And again, a lot of that money has gone into growth stocks that we hold within KWEB, companies like Tencent, Alibaba, Meituan. But actually, we think there's a real opportunity because there's a whole host of companies have relisted in Hong Kong but are not Connect eligible. Companies like Baidu, JD.com, NetEase, and Trip.com. Today's China last night mentioned that one of the companies that hasn't relisted in Hong Kong, VipShop, is rumored to be exploring that, but they really should go for a dual cross list, because that allows you to get into these flows. And obviously we're seeing a tremendous, so the Chinese are buying China. On the next slide, I think we're seeing a lot of investors outside of the US reallocating to China. If you think about, in Brazil, the largest company, or one of the largest companies by market cap in Brazil, is Vale, right? The big miner, and very dependent upon China. In Australia, BHP is the largest company in Australia. So in Switzerland, Glencore is not the largest, but very big. And Chile, SQM, and Peru, Southern Copper. So a lot of institutional investors, they don't get their China news from the Wall Street Journal or Bloomberg. They're getting it from watching the largest companies in their market. And certainly the trade numbers also show that ASEAN is China's largest trade partner. And so again, a lot of institutions in Asia, they understand China because the Chinese economy is such a big part of their economy. Now in Europe, we've seen a lot of inflow into China. And what's interesting is we're not seeing that here in the U.S. I'm jealous, Shaolin. You and the team have done a great job. KWeb LN going over $1 billion in aggregate assets. But what's interesting, we're not necessarily seeing that here in the U.S. Now, yes, KWeb listed here in the U.S. is like 150% of the total inflow into China ETFs, but it's actually net outflow for a lot of China ETFs. We've had about 2 billion of inflow into KWeb US. But what's interesting, Jalen, is the US ETF is 13 trillion. Europe ETFs are 3 trillion. So you have now why are all these European investors? Because they're not affected by this geopolitical narrative. And what's even more interesting is in broad EM, U.S. investors put 24 billion into EM, but in Europe it's 20 billion. So if you think about the China and EM flow, Europe is still way ahead U.S. investors. And what's more remarkable, Jalen, if we looked at call it the 1.5 billion that's gone into China ETFs listed here in the US, and then we said where would that rank amongst US ETFs that are geared to the US market? And I'm glad you're sitting because this is crazy. It would be the 78th ranked ETF. There's literally 77 ETFs that invest in US equities have gotten more money than China. And that's despite we're doing twice the return of the S&P 500. Now obviously a factor for a lot of non-US investors has been the US dollar's really weak, that the Swiss franc and the euro. You're not up 15% in US equities if you're denominated in Swiss francs, if you're denominated in euros. You're up low single digits. So we're seeing this rebalancing effect. But again, US investors are not participating, particularly institutionally, which we'll show on the next slide. We've spoken about how we utilize a research firm called Copley Fund Research. Steve Holden and team do a great job. And so here we're looking at this is actively managed mutual funds benchmarked to MSCI All Country World. So these are global funds, and we're looking at US, Europe. What's incredible is that a little more than 20% of these EM funds that are active, I'm sorry, these global funds have no China. I mean, China is doing twice the return of the S&P 500, and they have zero China. I mean, they're underweight. The underweights come off about. We're down to about a 50 basis point underweight, but just incredible. China is doing so much better than the U.S., and yet these professional investors are underweight. On the next slide, when we look at EM funds, now EM funds can't not hold China because it's about a third of the index, but their underweight is about a 3% underweight relative to the MSCI benchmark. And you can actually see on the right hand, the underweight's actually increased recently. I mean, you've got this great return, and it's actually the underweight's actually increased. I mean, just gets me really excited and constructive. The other thing on the next slide is we looked at and our compliance makes us use the KWeb top 10, because then people would accuse us of oh, you're cherry picking the numbers. So this is just the top 10 of KWeb. We looked at what have the companies generated in revenue from 2021 through what's anticipated through the end of the year. And you can see, these companies are growing top line growth. And then we compared that. Well, what's the stock done from their all-time high? Which for most of these companies, it's back in February of 2020 when the U.S. hedge fund Archegos imploded. Now, what's interesting is if we extended this below the top 10, the numbers actually get even more dramatic. JD Health has grown revenue 150%, stocks down 80%. I mean, this is the cheap part of China tech. That's relative to some of the expensive semi names in mainland China, but certainly very inexpensive when compared to their U.S. equivalents. And on the next slide, I think to articulate, to quantify what does this U.S. underweight look like? J.P. Morgan hosts a conference semi-annually around the IMF World Bank meetings in Washington, D.C. And as part of that, they survey the institutions that attend. This is more than 300 institutional investors, and they say, what do you own? Global equities, U.S. But it's shocking to me that 41% of those institutional investors own zero China. Another 35% are underweight, 15% are neutral. I mean, literally only 9% of these U.S. institutional investors are overweight China. And I think it's the geopolitical, because a lot of these U.S. institutions, even though the investment teams are MBAs, CFAs, they know they should be buying inexpensive stocks like China tech, but they don't necessarily have discretion. Their allocations have to be approved by their board of directors, their trustees. And those non-investment professionals, because of the geopolitical narrative, that's the culprit. And again, that is why on the next slide, why this U.S.-China trade truce, this trade detente has been so important, because you have this huge pool of capital is sitting on the sidelines, is not participating despite this performance. And again, we see this re-rating happening in Europe. It's happening in Asia. It's happening from non-U.S. institutional investors. And again, the real importance on the next slide is that an improvement in the U.S.-China trade deal, as you articulated, Jalen, it will allow those boards, those trustees, to allow these investment professionals to buy low. And again, there's a lot of scar tissue for investors, and that's what gets us so constructive on the space, is that even with this really, really strong performance, a lot of investors, particularly those here in the U.S., are not participating. And just if we can keep grinding higher, it's just going to pull that money in, because eventually underperformance becomes tracking error. Eventually it's called negative alpha. And if you don't allocate, you're fired. And that's what gets us really excited as we think about the remainder of Q4 going into 2026, and certainly a number of catalysts. Tomorrow, Jalen, we got to get a good night's sleep, because we've got Tencent, we've got Bilibili and JD reporting tomorrow. And as we saw today with Tencent Music and Entertainment, outstanding results, beat analyst expectations. I just don't think investors are really prepared for potentially some really strong catalysts. And again, we really do believe that President Trump, President Xi, there's a relationship there. We can get some positive momentum. And in terms of changing the narrative the geopolitical, particularly here in the U.S.
Yeah. Brandon, I know, I was just looking at my watch. It's 12th of November, and the Singles Day wrapped yesterday. I know you mentioned some of the takeaways from Singles Days with some of the companies in your CLN. Do you want to share briefly here with the audience?
Yeah. I mean, certainly, JD announced that they grew the number of people placing orders. I think it was up 40% year over year. The aggregate number of orders increased 60% year over year. We anticipate we'll get Alibaba will provide some clarity on their Singles Day success, but over the next several days, they're going to announce their financial results on Tuesday, November the 25th. But we anticipate we'll get some news there. So yeah, I mean, Singles Day, really strong performance from JD where we have some clarity. And again, we're seeing some early strong results from, say, Tencent Music Entertainment, and yeah, fingers crossed on a healthy Q3 financial results. I know Jalen just again, if CE credit, please email us at CE Charlie Edward at KraneShares, CFP SEMA CPD. If you're live streaming, please email us questions at info@KraneShares, and if you're joining us on Zoom, please use the Q&A button. And then obviously, again, if you want to get the deck, please just email us at info@KraneShares.com.
Voila. We have a few minutes to get a few questions down, shall we?
Yeah. And I know we got one just sees from the Q&A button here. Some questions rolling in, and one question I know, and I know our friend Winnie actually emailed us this question, just like, it doesn't really look like the portfolio in KWEB has changed much. And
Okay.
I think one thing that we're seeing in this re-rating of China's very robust IPO market. So we've not seen a lot of IPOs in the KWEB space as of yet, but certainly we believe Sheen can go public. I think we could see DD relisted in Hong Kong. We could see Ant Financial potentially come public. Obviously, ByteDance could come public. So again, the composition of KWEB has not changed really dramatically. I would point out the drivers of performance have changed. We've seen online entertainment players, like I mentioned, Tencent Music Entertainment, but Bilibili, Quashu, really strong performance. Online gamer, NetEase, really strong performer. Tencent's done well. So Alibaba, some of the e-commerce players like JD, Meituan have been a little bit laggards. That's why it's a diversified approach. But certainly, yeah, I think Sheldon, some, I think we're starting to see this re-rating in capital markets, and I think we'll see some IPOs and within the KWEB space, hopefully in the not too distant future.
Yeah, I'd agree. Hong Kong started to pick up on IPO this year. I think the numbers of the company, they at some point they said they have reviewed over 200 applications, but I think this year so far they launched about 60, slightly over 60 companies in Hong Kong. And obviously that's across all the different industries, like Brandon explaining, may not everything fits into this category. And then if I remember correctly, it's probably about 180-ish, but this is Hong Kong dollars, of billions has been raised in Hong Kong. And there are still more companies to come in this space. But remember how we build our index. If any new opportunity comes, KWEB will be able to include that on day 10, right?
Yep.
So that was.
I think this is funny, John. We got our friend Siwat in actually emailed us overnight about in our China last night review last week. We articulated some of the measures taken from both sides. This dialing, this detente, this truce. and Siwat said, hey, you mentioned that the China tariffs came down from 34% down to 10%. What and we Siwat, just so you know, I sent a response to my colleague to forward that to you. But just so you know, what we were talking is one of the very specific tariffs what came down from 20% to 10%. The U.S. Put on a whole host of different tariffs on China. There was a fentanyl tariff. There was, ship and port fee tariff. We mentioned that we were highlighting one of the specific tariffs that came down pretty dramatically. We weren't saying that the aggregate, we weren't saying the aggregate tariff came down to 10%. It is a little bit higher. So yeah, that, just wanted to let you know we definitely address that. And as always, please email us, info@KraneShares.com, if you have questions. We're Xiaolin and team in Europe, certainly our team here in the US is always available. Don't hesitate.
Do we get a few minutes for another question or so? This one is interesting from Jamil, our long-term friend. Jamil is asking if Ants Group are likely to go IPOs in 2026 next year.
It's interesting, Jelen, we saw it, I think it was about a few months ago, Ant was given a kind of a financial license in Hong Kong, which I think the market, interpreted, is this a sign of a, it certainly has been quiet. I think, I think you were more likely to see companies, Shein, I mentioned Didi, ByteDance. The only reason I think Ant might be a little bit slower is that, and again, this goes back to the basket approach at KWEB. One area where we've seen some weakness, and I touched on e-commerce because of efforts to try to jumpstart that domestic consumption story, something that, again, to your point, your slide on the 15th five-year plan, something we think is coming, Jelen. But one area where credit has been weak in China, and you see that from some of the official numbers that the China, it's not a supply issue, it's a demand issue. And so we've seen from Tencent, their WeChat Pay does an element of that is credit lending. Some of the direct players in credit lending, those numbers have been weak. And I think that arguably the upside for the players is, as we see further implementation of the 15th five-year plan, to your point, Charlie, it's domestic consumption, big part of the plan. And so I think you're more apt to see an Ant go public, when we see a further reacceleration in credit lending within China.
Yeah. And we got this question, Brandon, if I may have the time to answer it. Can we get the deck up, please? So the question was any chance of launching anything that UK investor can invest into? So if we can go to the product page right at the beginning. Obviously, we also had a question asking if we can get the deck. Please email us at info@KraneShares.com. We'll send you the deck. But if you get to the deck at the very beginning, here you go, on to point. Here you go. This is the products page of where our three pillars are sitting to. I don't know if you can see the little stars at the end of the name, so you can try to spot them. For instance, right at the very much the left-hand side of KWEB, that's our flagship ETF, KWEB. This fund is available in UCITS, is on LSE, is available in Euro, US dollar, and GBP share class. So it is available for UK clients. If you move down slightly on the fourth one, KSTR, obviously all these funds available in US. Okay, these marked ones are available in UCITS. K-Star, this is China's own NASDAQ. This fund is also available on LSE, available in different currencies as well. If you slightly move to the middle, there you go, Buoyed. This is the fund we discussed on the global robotics. This fund is also available on LSE. Obviously, we're trying to get this up on Milan and Germany. The other two I mentioned early on is also available on Milan and in Germany. Then buoyed is available in UK, in euro and dollar, and GBP share class. And if you move to the right-hand side, where you see now the mouse is cursing at, carbon, this is a global carbon strategy in the ETC format. This fund is also available in UK in UCITS formats. We also have KBA equivalent of Chen. I'm trying to search. It's called CHIN. That's the S&P 500 of China. That's the broader China play that Brandon mentioned at the end of the page, how you can access that. There you go. So we answered that. Just cautious of time. Shall we answer a few more questions, or we good?
Yeah, I know, our good friend Matt, asked just a question here on, Alibaba monetizing, that they have these great, the Q and large language model. And I really think where we're seeing is a lot of policy support from the top down for AI, this AI integration at a corporate level and for Alibaba, but additionally, I really do believe Tencent and Baidu, the monetization is going to be on the cloud side. That I think ultimately the AI chatbot, there's no moat to that business.
Mhm.
And I think the revenue model is going to be much more tied to the cloud. And we were able to speak to um, our good friend, and I'm just literally blanking on her name, our friend, on what an internet analyst, and I'm just actually having a senior moment here. But she had really thought that that she thinks that as we head into the quarterly Alibaba, that they might be able to grow the cloud revenue by 30% year over year.
Mm.
Fawn, sorry, Fawn, um, over at StoneX, and yeah, I think that's kind of the revenue model that we anticipate in terms of we had one question just around kind of KWeb index methodology that KWeb looks at subsectors, and so we look at subsectors like e-commerce, social media, mobile payments, online video, online games. And that's why we cut across a multitude of sectors, discretionary, communication, as well as technology. That's a little bit of what makes KWeb unique. And then, certainly we do rebalance that on a semi-annual basis. We do have an fast track for new IPOs. And we want to get those significant IPOs into the portfolio as quickly as possible. But yeah, it's a semi-annual index review. Obviously we apply a minimum market cap as well as some minimum average daily volume. But yeah, it's a semi-annual index review. So and certainly, yeah, I guess a little bit related. We have migrated a lot of the names to Hong Kong. That was initially because of some of the risks associated with delisting, which the Holding Foreign Companies Accountable Act with the Chinese actually changed the law to adhere to U.S. accounting standards. So we think that risk has vastly diminished. What's interesting is a lot of the flows migrated to Hong Kong. It's really interesting that a lot of the KWeb names that we hold, they actually trade more in Hong Kong than in the U.S. Part of that's because of southbound stock connect, other factors. MSCI's migrated out of a lot of the ADRs into Hong Kong as part of their index methodology. Yeah, it's interesting.
Right.
Okay, well, certainly, Xiaolin, yeah, if there's other questions, if we didn't get them, please email us as always at info@kraneshares.com. Certainly very constructive. A number of growth catalysts out there. But again, yeah, we certainly see this underinvestment, something that, pain trade is higher in my opinion. But yeah, until next time, yeah, certainly looking forward to reconnecting. And again, please don't ever hesitate to reach out.